Holy hell. I'm your host, Steve Metre, and thanks for joining me today. In our show today, a major threat to Trump's economy just surfaced, and as you're about to see, the fallout could be huge as millions of American households are now at risk. Plus, we have a sponsor for today's show. I'd like to welcome SOL Global Investments to the show. You can find them on the CSE under symbol SOL and on the OTC under symbol SOLCF. And they're focused on the price appreciation and generating yield off the token Solana. And this is very similar to what MicroStrategy is doing with Bitcoin, and Wall Street absolutely loves this as their stock is now entering the second phase of a major swing. This is one you don't want to miss out on. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where he picked today's story up as U.S. companies have added a mere 146,000 jobs in November. This according to ADP, and this is a huge problem for Trump's economy because what we're seeing is decelerating payroll growth heading into his term that doesn't start until January. So he has no opportunity here to change the labor market, and by the time he takes office, things could be much worse. And from the global economy's perspective, well, when things start to go wrong for the U.S. economy, well, it means absolute devastation for the rest of the world. And private payrolls rose by 146,000 last month after an October increase that was rise down to 184,000. And this is something we're seeing with the headline payroll data, continuous downward revisions. It's all about the data. We know the data is highly inaccurate here, particularly at the government level, who moved all the local level jobs to Washington. And that means the quality of our payroll reports going forward are absolutely horrible. I mean, we're likely to see further downward revisions. The report showed employment growth was mixed among industries. Education and healthcare, along with construction, led gains, while manufacturing employment, this is a critical one, dropped by the most in over a year. Hiring, leisure, and finance was also soft. And this is very scary for the U.S. economy because the manufacturing sector in any economy is absolutely critical. And when you start to see the manufacturing sector decline and start to cause layoffs, well, it's only a matter of time before it impacts the services sector because manufacturers, well, they drive about 70% of services side consumption. There's a huge risk here to the U.S. economy. The ADP report showed wage growth picked up. However, workers who changed jobs saw a 7.2 increase in pay, and those who stayed put experienced the first acceleration in 2 years. And what I want you to see here is how the mainstream media is covering up the truth, because literally right in the press release of ADP, it showed the income for job sayers increased by 4.8%. Now, why the media wanted to cover this up, I'm not really sure, but there's a real issue here is a lot of people are going to look at this data and say, well, that's great news. That could drive inflation as people are getting wages. And that's what we're likely to hear from the Federal Reserve later this month. But it's a danger sign for the U.S. economy. It's a huge warning. I'm going to show you how this is going to affect millions of households, because let's take a look at this chart. When we look at average hourly earnings of production and non-supervisory employees, this shown in blue on a year-over-year rate of change. And when we see it decelerate amid rising continued unemployment claims, well, it's a dangerous sign, because what it means is workers are losing their jobs. And we talk about how this is going to affect millions of American households, is we could see Americans losing their jobs at a time when we're keyed on a global turnaround centered around U.S. consumption. But if we do not see wages continue to increase at a fast clip to offset inflation, well, what it means is consumption is going to decline, and that means Americans are going to hit the unemployment line in a big way. We could see that happen again right around the dot-com bubble as wage growth peaks and then decelerates as Americans lose their jobs. We have it happen again during the global financial crisis. So it's important to understand here is while the data says, hey, there's payroll growth, well, that happens always during a recession. People who do have their jobs continue to get wage increases. They're just not as much as they're used to or hoping for. The problem is that means Americans are hitting the unemployment line, and we're seeing now what ADP is telling us is that wage growth is continuing to decelerate amid rising continued claims. But let's talk about a chart that's looking to head a lot higher, and that is for our stock, for our sponsor. They show SOL Global Investments. You can find them on the CSE under symbol SOL and on the OTC under symbol SOL LCF. And we can look at what a swing trade is. So this is when you get a close above a rising 9-day moving average. That happened right back here. The stock took off. It's pulled back underneath its 9-day. Now, for some people, that triggers a sell. Really, the sell signal is under the 21-day exponential moving average. Here you can see today it's looking to make a close over the 9-day and set up another leg higher. This is a stock that Wall Street loves and one we think you will as well. Stay tuned to the end of the show for more information. But let's continue on what's going on with the U.S. labor market, because U.S. services activity now expands at the slowest pace in 3 months. And this is a huge change, because what we've been hearing is the services sector in the United States was going to drive the manufacturing sector. And we've looked at the data and we've continued to say that where manufacturing goes, services follow, because manufacturers drive a massive amount of services consumption. Well, what we're now starting to see is a slowdown hit the services sector, threatening in a matter of a couple months that could be heading to a negative. The Institute for Supply Management Index of Services dropped 3.9 points, the first decline since June, to 52.1 last month. While readings above 50 indicate an expansion, the key here says the expansion is slowing. The group's new orders gauge decreased by 3.7 points to a 3-month low of 53.7. So what we're seeing here is new order growth start to slow down, and this is dangerous, because remember, the workforce in where there's manufacturing or services, they need new orders and they need backlogs. You get both, that means people have jobs. You start to see slowdowns, and well, that means they're going to have layoffs. A measure of business activity which parallels the ISM factory output gauge also fell to the lowest level since August. And survey respondents noted some apprehension about the potential for tariffs after President-elect Donald Trump's victory. So what did we hear before the election? That was all about election uncertainty and the consumers weren't spending. Now we're seeing a change in that from the services side, saying, well, maybe things are going to get better, but not until this tariff issue is dealt with, suggesting that all along the election wasn't the issue. The issue was that U.S. consumers are running out of money. They can't keep up with inflation. And here we can see on this chart that the services sector that everyone was banking on the turnaround of the U.S. economy and the world economy is now rolling over to the downside following the manufacturing sector. And combined with data earlier this week is now showing an 8th straight month of contraction in manufacturing. The services survey suggests moderating economic growth in the final stretch of 2024. That is before we start to see the services sector decline and follow the manufacturing sector lower. And the evidence of that is strong as we look at the easing of business activity along with a 4th month of declining backlog of orders and a slide in export demand. So those are critical, because when you look at what we need to see people have jobs, get more hours, demand pay increases that they can keep up with cost of living, well, they need work. They need the new orders to continue to rise. They need the fax machine to run, but they also need that backlog to stay there. What we're seeing, the backlogs get worked down. We're seeing export orders fall, and this means we're going to see hours cut and then employment get cut. And this led to a tempering of employment growth at service providers. The ISM measure slipped 1.5 points to 51.5 last month, suggesting that employment among service providers grew very slightly. But let's look at some of the comments that we saw from the survey, as Federal Reserve rate cuts have not had the desired effect on mortgage rates yet. Well, that's simple, because the Fed chases the short end of the curve. We looked at these charts where the Fed responds to approximately 6-month Treasury yields. But why have long-term rates not come down? It's simple. Everyone believes that a slight cut in rates is going to lead to an economic boom, driving growth and inflation. What we're seeing here is the market bet on that, and yet what we're hearing from the services sector is that's not going to happen. And now we're switched to tariff uncertainty, as we see here, but the unknown effect of tariffs clouds the future. We again have concern after the presidential election that tariffs will affect prices, and election results and potential tariff changes would impact inventory. We're going to talk about inventory later in the show, because this is a huge issue and another factor, because one place we look to inventory, and that is consumption. And right now, Foot Locker is saying that things are getting worse for a lot of Americans, and they see their stock plunge on softened sneaker demand. demand as low to mid-income consumers feeling the brunt of sticky inflation, elevated prices, and high interest rates have dialed back their demand for fancy sneakers. And really, it's not about those issues. It's not about higher interest rates. It's all about the fact that wage growth isn't increasing, hours worked aren't increasing. It's because demand isn't there. And for low to mid-income households, well, this is bad news. And that means for Foot Locker, well, they slashed their full year guidance after reporting dismal third quarter earnings. But look at this, comparable sales increased 2.4%, not even keeping up with inflation. But look at something else that's really interesting in their earnings is their total location count dropped 6% year over year, indicating that Foot Locker's closing stores. Now we're hearing this from other manufacturers, we're hearing this from other service providers, that because of a lack of demand, they're reducing their footprint. This is putting Americans out of work and going to cause a domino effect throughout the economy. Foot Locker notes that consumer spending trends softened following the peak back-to-school period in August, and the promotional environment was more elevated than anticipated, indicating that Americans need discounts. And that's a key factor here because we've noted, again, consumer prices too high, wage growth too low, and they're commanding and demanding discounts. If they don't get it, they don't spend. And despite the strong performance, we're taking a more cautious view and are lowering our full-year sales and earnings outlook due to a more promotional environment and softer consumer demand outside of key selling periods, indicating that consumers come out and buy when there's discounts, and when they're gone, they go with them. For the full year, Foot Locker now forecasts sales to dip 1 to 1.5%. That's put a negative in front of that as compared to previous guidance of down 1% to up of 1%, indicating that what we see against inflation is that Foot Locker sales are going to decline. That means they're going to cut hours, they're going to cut more stores, and that means more Americans on the unemployment line. And we can see that as we look at average hourly earnings of production and non-supervisory employees still shown in blue on a year-over-year rate of change against real retail sales. And what we see here is that what's affecting consumer paychecks is directly affecting companies like Foot Locker, as we see decelerations in wage growth lead to an absolute collapse in retail sales. You see them come more in line going to the global financial crisis around 2006. We see a peak in wage growth, and that meant retail sales came down. We see that effect happen around 2011, and then we're seeing it now with 3 years now of negative real retail sales on the back that we know wages, according to ADP, are continuing to decelerate. That means spending is going to go down. So we talk about how a lot of companies ramped up inventory. They got prepared for this post-election economy, and what they're finding out is nothing good is about to happen. And because of that, Foot Locker's authorizing new share repurchase authorizations, now up to 1.2 billion of shares. And we talk about how banks don't want to lend and they'd rather lend to governments where they're guaranteed the coupon off the bonds. Well, look at this. You see Foot Locker, they have revenue, they have cash, but they don't want to invest it in new stores. They don't want to invest in upgrading their stores, and they don't want to invest in employees. So they do the only other thing they have, and that is buy their stock back, because they're seeing no opportunity in this economy to expand or take market share. That means millions of Americans facing the unemployment line. And when we look at the energy markets, well, we see the same effect. We see consumers cutting back. We talk about, again, the risks of the economy, and that is demand plunge. You look at gasoline inventories up 2.36 million, distillate inventories up 3.38 million. So as we look at the travel season, Indy, we're facing energy inventories on the way up, and that means, of course, again, comes back to demand, and when demand goes away, prices fall. And look at what OPEC, they see now oil is edging lower. As today's headline is U.S. economic data undercuts OPEC plus deal gains. And in the end of the day, it's not about wars, it's not about OPEC. Those are all short-term factors that we can see disrupting the energy sector. It's all about the U.S. consumer and consumers all around the world. When they see their pay going down, well, that means consumption goes down and oil prices go eventually with it. As we now look at total income growth, this showing average hourly earnings multiplied by average weekly hours of production to non-supervisory employees. This is in blue on a year-over-year rate of change against West Texas Intermediate crude, that shown in red. What you can see is total incomes decelerate while crude oil prices head lower. Now, that was a little bit different going into the global financial crisis where crude oil prices surged but had mean reversion to incomes. You see how around 2010, incomes start to slide, oil prices rise, and then eventually come crashing down. Around 2018, they're right in sync with incomes, and now we see oil prices likely to head lower. And what we're seeing based in the inventory data with gasoline and distillates is consumers are tapped out. And that means for suppliers, that means for inventory levels, bad things are coming. Take a look at Maersk. They have a sell rating now stacked up on shipping oversupply concerns. Now remember, we warned about this back when they were building ships like crazy. We said, look, there isn't going to be demand after the pandemic. There's a massive oversupply here. And when you get an oversupply, what does that mean? More workers all around the world out of jobs as oversupply concerns have reemerged after a boost to shipping rates from attacks on the Red Sea vessels by Houthi rebels have faded. The sector has been left with excess capacity, same thing we're seeing in the U.S. and global manufacturing sectors, after it invested in fleets during the disruption caused by COVID-19. Meanwhile, new tariffs pledged by U.S. President-elect Donald Trump are seen potentially curbing demand. And again, demand means fewer hours, fewer jobs. You talk about millions of American households being impacted in this coming economy where we're seeing a massive slowdown. The fallout, again, could be huge. And we talk about retail inventories. Well, let's take a look at this against the unemployment rate, because what we're seeing is a lot of inventory building right now yet, particularly as China dumps into the U.S. before the tariffs hit. And what we can see is inventory levels start to fall as the unemployment rate rises. And what this is indicating is that manufacturers are realizing there isn't enough demand, and wholesalers and retailers along the chain are saying, look, we're going to clear out our inventory before we order any more. And that puts people on the unemployment line. You see the risk right now. Inventory levels on a year-over-year rate change are rising as the unemployment rate is, and that means there's going to be a lot of unemployment coming in the near future. But one thing we think has a huge opportunity, that's for the stock for our sponsor of today's show, SOL Global Investments. Again, you can find them on the CSE under the symbol SOL and on the OTC under the symbol SOLCF. Everything you need to know in the pinned comment and description below. And they are an experienced team driven by performance. SOL Global Investments is a diversified private equity firm targeting the best-in-class companies that operate in ultra-high growth industries. Our team has a proven track record of identifying pioneering businesses that are poised to disrupt the status quo and take advantage of strong industry tailwinds. We are always on the lookout for exciting opportunities to augment our portfolio and drive growth across our target sectors. Their current portfolio is built on the thematic trends that ensure we're always in front of the grid. Our core holdings include electric mobility, digital asset technology, esports and gaming, new age wellness, and residential commercial real estate. But they've announced recently a strategic change with the investment focused on Solana. This happened on November 4th, and through Solana's efficient and scalable network, SOL Global aims to harness growth in decentralized finance and next generation applications as part of Solana's commitment to advancing innovation and enhancing digital capabilities. And this is something Wall Street absolutely loves. It sent their stock soaring and is now in the early phases of kicking off the second move of what could be a monster swing trade. Again, find them on the CSE and symbol SOL and on the OTC and the symbol SOLCF. And we're excited to make the strategic investment in Solana, a blockchain platform with the speed, scalability, and security that aligns with our vision of the future. Our investment research found that Solana Network provides us with the greatest opportunity for growth. And they provided a corporate update on November 8th as they look to de-risk their balance sheet by converting debt holders to equity. And when debt holders are willing to exchange their debt for equity, this is huge, because what they're seeing is a tremendous upside potential in SOL Global, one greater than what they would get by holding the debt and getting a payback. And SOL provided a second update on November 18th as they intend to hold the tokens and benefit from price appreciation as well as yield through a process called staking. Staking is a mechanism that supports the Solana blockchain's network's operation by delegating Solana tokens to validators on the network that use stake-weighted consensus votes to validate transactions on the blockchain and thereby maintain network integrity. By staking Solana tokens, SOL Global will participate in the Solana network's proof-of-stake consensus mechanism, helping to secure and decentralize the blockchain while earning rewards for its contribution. This investment strategy not only offers potential for asset appreciation, but also enables SOL Global to generate a steady yield, enhancing the long-term value of its holdings. And one thing we think could enhance the long-term value of your trading account is the second phase of what Wall Street is really excited about in terms of a massive swing trade. You see back here, it kicked off on the news that they were following the strategy implemented by MicroStrategy, what they did with Bitcoin. Now we're seeing the same thing with Solana, with SOL Global, and that kicked off a huge rally in its stock. It pulled back below the 9-day moving average today, looking to close above it. All we need to do is see the 9-day moving average turn higher and price stay above it, and that kicks off the second phase of the swing. And we can see today it's potentially closing over a 6-month volume profile, providing a massive amount of support under SOL Global, suggesting that indeed we're likely to see another major move in their stock. Again, you can find them on the CSE under symbol SOL and on the OTC under symbol SOLCF. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.